Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. I'm speaking to you from London in early August. Well, it's been yet another good month for investors, and I should explain why. But the numbers first, Solutions up about 3%, Dynamic 5%. That brings the year-to-date numbers to 14% ahead for Solutions and 20% for Dynamic. So clearly exceptional returns, which are nice to report. I should explain why. It's been an interesting period. What's really worked over the last 7 months now for investors is that we've had a combination of factors. Most importantly, economic growth remains positive, led by the US. Secondly, and we're getting evidence of this now in the results season for the first half of the year, the companies on average are making more profit this year than last year, and investors are therefore benefiting from that growth. Stock selection is a different matter, and I'll come to that. The next element that's been driving markets higher have been interest rates. Central banks around the world are now reducing interest rates. The cost of money is going down, and the US Federal Reserve during July has joined in with this. This is incredibly influential as far as markets are concerned. Both Dynamic and Solutions, apart from the capital growth side, are invested in things that produce income. So the yield of 2%, for example, for Solutions is just getting more valuable. Investors searching for income are faced with a world of negative interest rates, particularly in government bonds, and therefore they're looking for alternatives that make them money, cash flow, and that is supporting markets despite the issues that we all recognise. And again, I'll touch on those as well today. Asset allocation remains pretty well unchanged. Dynamic is 94% invested in equities with about 6% in cash at the moment. Solutions is more broadly based, 28% in fixed interest and cash, 56% in equities, and the balance in alternatives. They've been pretty well there all year. So let's talk about stock selection and the results. What's come through loud and clear is that some companies are winning and some are losing. We've heard a lot about the problems of the technology sector, but companies like Alphabet and Amazon have generated and are delivering 20% growth in a zero interest rate world. Exceptionally valuable. Facebook, despite a €5 billion fine, delivered 30% growth. These companies are growing despite the regulatory pressure that's building on them. That's very valuable to us as investors. Beyond that, there are companies with just good global brands, Visa, Coca-Cola, to name a couple, just knocking out good revenue growth each quarter, valuable in the extreme. And apart from those companies, others that have done really well for us this month have been Vodafone, T-Mobile, for different reasons, also Ares. The list goes on. It's across the board. If you're picking stocks, there are companies that are benefiting from the current environment that I've described. So that's where we were just a few days ago. But to bring you right up to date, Thursday of last week, we had a presidential tweet which really started the trade war with China afresh. More tariffs to come. That has upset markets, and it would be wrong of me not to say there are things that are bothering us. So the trade war is getting hotter again. In retaliation, and I think this is managed by the Chinese government, the renminbi is falling in value. This makes Chinese exports more competitive. It's a way of disconcerting the Americans, and they're using it from a position of strength just to tell the rest of us that they can do it. So this is running. And we'll see where that goes over the next few months. But it looks like both sides are settling in for a long fight. It's not the same as being pessimistic, but I think we just have to be aware of that. The other issue in the same area is the protests in Hong Kong. Now, they may or may not continue. They've been going on for a while now, but getting worse. Not that it's causing trouble in China, because I think there's pretty well a good news blackout there, but the rest of the world is looking in. And 60% of inward investment from the West into China flows through Hong Kong. So it does matter what goes on there, and we'll just have to wait and see on that. Brexit, well, it's getting serious for those of us that are in the UK, but it's still more noise than action. We have a new Prime Minister, the government has been reformed, positions are being taken, negotiations or bluff and counter-bluff, however you want to put it, will continue, I think, for the next month or so. But the politics is complicated in the UK. That's just the bottom line at the moment. Most importantly, though, it's not having any particular effect on the portfolios that we're managing. We're international in our approach, diversification has helped us, and even where we are invested directly into UK assets, mostly they have an international tinge to them. The other feature of this year so far has been we've made money in every asset class. So despite all the trouble, gilts, British government stocks have actually made us money this year. There is a flight to quality, there is a safety element to it, but importantly, both US Treasuries and the gilt market still offer a positive yield in a world of government bonds yielding less than zero. Germany up to 30-year maturity, negative. Switzerland as far as 50. These are extraordinary things to report. We're not taking part in that negative interest rate environment. We're finding ways to earn a positive return. So that's where we are at the moment. A little bit of disconcerting news coming out in the last few days. Markets are reacting as they do. We'll have to see how those events unfold. So in conclusion, we are and have had a good start to the year, 7 months of really positive returns. There are things that may or may not unsettle investors over the coming months, but our view is that on a stock selection or stock selected basis, we want to buy things that are growing. We think we can find things that are growing irrespective of political uncertainty. So if we do get opportunities to buy on days of weakness, we're taking advantage of that. So I hope you found that useful. I look forward to reporting to you in early September. Thank you.